You know that feeling. The news feed, it's just buzzing with financial terms, regulatory updates.
Yeah, it's a lot to keep track of, like trying to learn a new language sometimes.
Exactly. Well, today we're going to try and cut through some of that noise. We're taking a deep dive into something pretty significant happening with the Reserve Bank of India, the RBI.
That's right. We're seeing a definite increase in how the RBI is enforcing its rules. You could say a more assertive stance across the financial sector.
And to really get our heads around this, we've been looking at a pretty detailed report. It covers the RBI's actions in the last financial year, FY24 we'll call it, and the one before, FY23.
Mm-hmm.
We're going to unpack the numbers, look at why this shift might be happening, and explore this interesting idea called the governance premium.
And we've got some good perspectives here, insights from former RBI and SEBI officials, SEBI being the Securities and Exchange Board of India, of course.
Right, plus views from legal experts, even leaders in the fintech world.
So our mission today, really, is to boil this down for you. Understand why the RBI is doing this, what it means for banks, for other financial institutions.
And yeah, ultimately, what the ripples might mean for you.
Okay, so let's jump into the numbers first.
Let's do it. So FY24, the RBI imposed penalties worth roughly 86.1 crore rupees.
Right, and that was across 281 different instances.
Now, that sounds like a fair bit, but compare it to FY23. Back then, it was around 40.4 crore across 211 cases.
So it's a pretty significant jump, isn't it? Both in the total amount and the number of times they took action.
Definitely. And what's interesting is where that focus landed. The report highlights state-run banks and private banks seeing more of this increased censure.
Yeah, specifically excluding foreign banks and small finance banks in this trend.
And, you know, it does make you stop and think when you put these numbers next to what regulators do elsewhere.
Mm-hmm. Globally, you see fines in the millions, sometimes billions of dollars.
Right. So the question becomes, are these amounts, the ones in India, really a strong enough deterrent?
Or, as the report kind of floats, are they just seen by some institutions as, well, a cost of doing business, an operating expense?
It suggests that, you know, while enforcement is up, maybe the financial sting isn't quite at that international level yet, especially for the big players.
That's a critical point. The report even digs up the highest RBI penalty ever, about 58.9 crore. That was on ICICI Bank back in March 2018.
Yeah, for issues around securities sales directives.
And while that's a chunk of change, it's still, well, not in the same league as some major global fines we've seen.
And this is where I think it gets really interesting. The report suggests maybe we shouldn't just focus on the size of the fine.
Exactly. The monetary value might not be the whole story or even the most important part.
Right. We need to look a bit wider.
Absolutely.
Yeah.
M. Damodaran, former SEBI chair, he makes a really strong point about disclosure.
Okay.
He argues that just having to tell people about these penalties, reporting them to the stock exchanges, putting them in the annual report.
The reputational hit?
Precisely. That potential damage to their standing in the market, in the public eye, that can be a much more powerful deterrent than the fine itself.
That makes sense. And then Ravi Duvuru, he's involved with the RBI's Regulatory Review Authority.
Like RA 2.0, yeah.
He talks about the RBI using supervisory actions more. What does that actually mean?
Well, it's things beyond just fines. It could be, say, putting an institution under closer watch, restricting some of their business activities.
Oh, okay.
Maybe even pushing for changes in management. His view is that these actions can actually be more effective in changing behavior long-term than just a monetary penalty.
So it's a broader toolkit they're using.
Seems like it. And this fits with the RBI's new enforcement strategy mentioned in the report. They're shifting to a more scale-based approach.
Scale-based.
Meaning the enforcement action will increasingly depend on things like the institution's size, how complex it is, how interconnected.
It's a range of activities and obviously how serious the violation was.
Exactly. It's moving towards being more tailored, less one-size-fits-all.
And the report links this directly back to meetings the RBI governor had with bank boards. That was May 2023, right?
Correct. And the focus there was apparently very much on the fundamentals. Governance, how the place is run,
ethics,
the role of the board, what the RBI expects from them in terms of oversight, really foundational stuff.
Which leads us nicely into this whole issue of individual accountability.
Yes, a really critical point. Divyanshu Pandey from JSA, the law firm, points out that right now the RBI mainly penalizes the institution.
Not necessarily the specific people involved.
Not consistently, no. And there's a growing argument, which the report captures, that the RBI should perhaps use its powers more against individuals.
How would that work?
Well, things like looking closely at their compensation and really enforcing these things called clawbacks.
Clawbacks, right. That's where they can take back bonuses or pay if something goes wrong.
Exactly, if there's been misconduct or major errors. And this aligns with what international bodies like the Financial Stability Board and the Basel Committee recommend.
Has the RBI actually moved on this?
They did issue a circular back in 2019 about compensation and clawbacks. It was meant to apply to pay cycles starting after April 1st, 2020.
Okay.
But interestingly, the report notes it could potentially be used for slip-ups before that date, too. The Yes Bank case is mentioned as somewhere it might have been relevant.
But these things can get tied up in court for ages, I imagine.
Oh, absolutely. Potentially lengthy litigation.
Ravi Devuro, again, he really stresses that penalties need to be proportionate, right?
Yeah.
Linked to the institution's revenue.
And, crucially, tied to individual accountability, especially at the senior management level.
He even suggests looking at the UK's model.
Yeah, he mentions the UK's senior managers regime where personal responsibility for failures is much more clearly defined and enforced.
But are these clawbacks actually happening? Is money being recovered?
That's the thing. There's a real lack of public data on it. We don't know how much is being clawed back or from whom. And Duviro makes the point that there should be mandated annual disclosures on this for transparency.
Transparency seems key.
Yeah.
Now, another big issue the report flags is this time lag problem.
Yes, the lag between, say, a violation happening and the penalty actually being imposed, or even fraud being detected.
Right. So technically, how does that work?
Well, often the penalties are based on inspections or findings from an earlier supervisory period.
Ah, so by the time the penalty is announced?
The management team might have completely changed.
Yeah.
The people responsible might not even be there
The
anymore.
report compares this to the US and Europe after the 2012 crisis, right? How that led to big changes in executive pay, more clawbacks.
Exactly. A push for more accountability even after the fact.
And are these clawback systems everywhere now? Kritika Krishnamurthy from AK Partners points out.
That while some sectors, like insurance, might have them, they aren't universal across all RBI-regulated entities yet.
Her point is basically institutions need to get ahead of this, set them up proactively.
Pretty much. Show they're serious about compliance.
Okay, let's shift slightly to fraud detection itself. The RBI's own data, trend and progress of banking report.
Yeah, for FY24, it showed the lowest fraud amount reported in a decade. Which sounds good, but
But then there was a sharp increase reported in FY25. And the real kicker is the delay.
the lag, yeah, it's huge. For frauds reported in FY23, something like 94% of the value actually happened in earlier years.
94%. And FY24 wasn't much better still, nearly 90% related to previous years.
And the RBI's FY21 report gave averages 23 months lag overall for fraud detection.
And for the really big ones, over 100 crore.
A staggering 57 months average lag, almost 5 years.
Wow. Why such a long delay?
Jaya Batanathan from BCT Digital explains it well. She says traditional systems are mostly reactive.
Meaning they look for patterns they already know.
Exactly. So if it's a new type of fraud, the system might not pick it up straight away, hence the lag.
It's like you said, trying to catch a new virus with an old test.
Pretty much. But she suggests AI and machine learning could be game changers here.
How so?
By being more proactive. Spotting transactions that just look odd or deviate from normal patterns before we even know exactly what the new fraud scheme is.
Cutting down that reaction time.
Hopefully, yes. Moving towards prevention rather than just late detection.
And this loops back to culture, doesn't it? M.K. Jain, former RBI deputy governor, said back in 2019.
That a strong compliance culture is fundamental. It's about preventing those big losses in the first place.
And all this, the penalties, the focus on individuals, the fraud issues, it all seems to build towards this central theme in the report, the governance premium.
Exactly. That's the core idea, that having a really strong, effective governance framework, well, it's going to be increasingly valued.
Reflected in how institutions operate, how they're perceived.
Right. Think about it. Fraud is a direct hit to capital. If capital gets more expensive, then having good governance that prevents fraud becomes a real competitive advantage.
That's the governance premium in action.
And the RBI's whole enforcement shift seems designed to push institutions in that direction.
Okay, just to give people a concrete sense, what kinds of violations are actually triggering these penalties most often? The report lists quite a few.
It does. Things like contravening Section 26A of the Banking Regulation Act.
Cybersecurity lapses? That's a big one these days.
Definitely. Non-compliance with exposure limits, or those IRAC-C norms for asset classification. KYC issues the 2016 directions.
Problems classifying or reporting fraud.
Issues sending data to that central repository of information on large credits or to credit bureaus.
Customer protection failures, especially with unauthorized electronic payments.
Yep. Loans to directors not monitoring how funds are actually used.
And even breaches of specific rules for housing finance companies from 2010.
It's a broad spectrum, really. It shows the RBI is watching many different areas.
And bringing it back to transparency, Damodaran's point about disclosure to exchanges in annual reports.
Crucial. That public scrutiny is key for accountability.
And he also insists, rightly, that it needs to be a level playing field.
Absolutely. No difference in treatment between state-run and private banks for similar offenses. Consistency is vital.
Okay, so let's try and pull the threads together from this deep dive.
Sounds good.
We've definitely seen a clear step up from the RBI. More penalties, higher amounts in the last financial year.
And a move towards this more nuanced, scale-based enforcement, looking at the size, complexity of the institution.
Plus, this growing focus on individual accountability. Clawbacks are on the table, even if the data is murky.
We've also talked about the real challenges with time lags, both for penalties and especially for fraud detection.
And how maybe tech like AI could help bridge that gap in the future.
And tying it all together is this idea of the governance premium.
Right, the notion that strong governance isn't just box ticking anymore. It's becoming essential, valued.
Building a more resilient, trustworthy financial system.
So hopefully, you listening now have a much clearer picture of these shifts in India's financial regulation. We've tried to cut through the jargon and show you what's really driving these changes.
Yeah, understand the forces at play.
And maybe a final thought to leave you with.
Go on.
What would that governance premium actually look like if it was truly embedded in the system?
Beyond just avoiding fines, you mean?
Yeah. How could it genuinely build long-term trust, enhance stability, improve the overall health of finance in India?
And perhaps, what's our role as informed individuals, customers, investors in expecting and valuing that level of governance from the institutions we rely on?
Something to mull over.